I want to read out a quote from you at the end of last year because it really jumped out to me. We're going through a once-in-a-generation change. Every single client we deal with around the world is using fewer and fewer money managers. What does that mean to you?
Well, I've been in the industry since 1983. There's been a discussion that it's going to consolidate since that period. It just hasn't until right now. And I'd say this is really a post-crisis phenomena driving it. Just the cost for money managers through technology regulation is much higher, but also clients are demanding much more from their money managers. They want a broad range of investment capabilities, but also more. They want thought leadership. They want support in anything that they might be doing. And ultimately, it's a good news story for those managers that can deliver that, but it's a great news story for the clients. They get more. They'll get economies of scale out of it. It's a win-win story.
It's been tough for you. Last year was tough.
Yeah, absolutely.
Stock cut in half.
Yes.
Bleeding money, AUM sliding. What can you do this year to start to stabilize things?
Yeah, so we're on that track right now. It's early into the year, but we're looking forward to a very good year right now. Much of that, as we talked a minute ago, we went through the third largest combination in the industry. And typically what happens is that when you're going through that combination, the clients, until the combination is done, they step back.
So, Marty, for our audience, just so they can follow if they're not familiar with the story, integrated Oppenheimer, around about $250 billion of assets. Traditionally, what we see, when you start to absorb that size, you start to get some money go elsewhere.
That's
Things stop for a little while.
That's exactly right.
Does this remind you of what happened with the company at the turn of the millennium when you absorbed Perpetual?
Yeah.
It took a couple of years just to get things going. Will this be the same story?
There's no question about it. So what's the measure? So who are you talking to? The clients that we talk to, they're very supportive of the transaction. They say, what you all are doing is exactly what should be happening in the industry, and very much supportive of us. And we completed it in a very short period of time. We closed in May.
Yes, you did. Absolutely.
And
amazing.
We're really, on January 1st, we're off to the races.
I want to go to those moments in a year where you just stop. One of them was, of course, the headline of the ECB saying that they're going to stay on hold forever. Another one was sitting on the set in New York and opening one newspaper. The first ad, we're giving it away for free. I turned the page. It was another discount broker. We're giving it away for free. And then there was a third ad, 3 ads in a row in that retail space saying we're going to give it away for free.
Right.
Is a bond house of your great distinction. And frankly, with the Oppenheimer equity management internationally, how are you going to make profit knowing you're in a give it away for free industry?
Yeah, so nothing's for free, first of all. I think that's one point to make. But when we look at the range of capabilities, and really where those focuses were cap-weighted indexes, and they've grown enormously post the crisis. And when you look at the spectrum of how people build portfolios, cap-weighted indexes are in it. They're very cheap. But as you keep going up to factors, active alternatives, you get better returns, excess returns, you get downside protection, you're going to pay more for that. So clients are literally using the spectrum of assets classes like they never had before to get the outcomes they want.
Are you going to affect this with a close approach? We just had Lawrence Fincon from BlackRock. Are you going to do a so-called R-squared, folks, which is a statistic on this, tight up against what the indexes are doing? Or are you going to bring that R-squared down and really differentiate?
So that's really been what's been going on here. And this also was really coming out of, I'd say, regulation and really the focus on, there were active managers that were really index huggers, right? So you're paying an active fee for not much.
That's a surveillance break exclusive, folks. I did not know that occurred.
Carry on.
Okay, there you go. So the point is, you're seeing a lot of this movement of money away from that to those people that generate excess returns, and you can. But you really want the full range of capabilities when you're building those portfolios.
Marty, I want to talk about some of the problems that you have as an index provider as well. There's a lot of concern that people start to think there is liquidity in certain indexes, that the underlying securities that they track aren't very liquid at all. Leverage loans. You're a big leverage loan house. You've got the ETF. Does that not concern you?
Yeah, so when you talk about it at that level, you would. But when you have to look into the portfolio, what happens in the bank loan portfolio, there is probably 35% liquidity, and there's backstops to it. So it is not an illiquid portfolio that is open-ended in the marketplace.
But John went right where I wanted to go, which is your true expertise in leverage loans. I should point out, folks, that Invesco has been a huge supporter of what I've done for years and has been a supporter of Bloomberg Surveillance. In the old days, and I go back to David Goldman at Bank of America, it wasn't the garbage tranches that got us in trouble. It was the quality tranches coming from a 92 down to an 89 or an 85. Are we setting ourselves up for that same risk again?
Hard for me to answer that question, but again, that's the role of the portfolio managers, right? And if you have high-quality portfolio managers, they're the ones that are making that assessment.
Don't you worry, though, Marty, that those portfolio managers at the moment are being forced into quite a liquid parts of the markets, into private markets? Woodford, former colleague of yourself, got caught out earlier this year. Legendary investor, pushed into the wrong stuff.
So that is probably one of the current concerns. When I look at the market, all the money is going into private credit at the moment. It is it's everybody's answer to the question. And I've been in the industry long enough now, too. When everybody's going the same way, good things don't happen with that. That's a sweeping comment. The reality is you have to look at it manager by manager, the quality of the managers, their expertise, the ones that have been doing it for a long time, that are thoughtful and highly talented, they'll do okay.
John and I are humbled by the success of our podcast. Folks, we're targeting 1 million downloads a month. We're not there yet.
Very close.
We're trying to get there. If I look at them from over here,
we've got Invesco next to us, and we're doing a shameless plug.
A shameless plug for Invesco to sponsor our podcast so we can get home.
Is it free?
The podcast?
Yes.
It won't be free if you help us with it.
Okay.
Marty, the people that listen to the podcast, there's an intellectual group that want to be in your business.
Yeah.
But they want to know, is there a future to the CFA Institute? Is there a future to active managers? Is there a future to security research? What do you see?
Thank you for saying that. So all people talk about is a change in the industry right now, and they look at the downside, right? So there's absolutely, this industry is going to thrive. What's happening, it continues to grow. It's almost a $100 trillion industry right now. Who's talked about that? It is not going away. And the need for CFAs and smart people to do the work, it's always going to exist.
Okay, it's going to be there. With an Oppenheimer combination, how do you meld those two cultures together? Because I'm sorry, I remember the Oppenheimer Target Fund from a few years ago. Folks, it's like decades old in their international excellence.
Yes.
How do you culturally meld all those egos together?
Yeah, so that's a very good question. So been through a number of transactions in my career, and the first conversation, everything looks good on a piece of paper. That's not what matters. It's spending time with the people, understanding the culture, and are you culturally aligned? That's the first. If you don't get that right, you have a problem. And I don't know when you do, but you will. Each team is separate and distinct. They continue to do exactly what they did when they came to Invesco, and that will not change. Our whole goal is to give them greater resources to do what they've done in the past, is to make them even better than.
Marty, let's get some targets if we can.
Yeah.
Current AUM, how much of that is passive? About a quarter?
Yeah, it's 250 billion of it.
So about 25% in and around.
Right.
Any targets to get that up to a certain level? What's the ultimate balance for an asset manager at the moment?
So I get asked that all the time.
Okay, not the 3 digits, go to 2 digits.
Let's say that. So the answer is clients determine that, right?
Okay.
So at the other hand, we have almost $200 billion in alternatives, and it really is your expertise and where the clients are moving it. So I feel really good about the talent that we have, and it's really us spending time with our clients and making that difference for them.
What about the international mix? What are you seeing in flows of fund now? Q4 was finally an Oppenheimer, an Invesco Oppenheimer quarter. Is that, from where you sit with your knowledge base, is the international joy of the last quarter going to continue?
Yeah, so it's a fundamental strength of the firm right now. You talk about emerging markets, our expertise in China, staying on China alone, just the growth in China for the money management industry, and the interest in China is at a peak level, as you would imagine. And we see that. It's early in the year. That's what's going on right now.
Well, it's going on right now, but the strategy forward here to compete you're in, everybody likes to talk about scale, and we do touchy-feely at Davos. You're in a brutal industry right now. What's going to be your best practice forward?
So international equities is one. Emerging markets, very, very talented. China, for us, just a fundamental strength of us. We manage $70 billion in Chinese securities. We have $50 billion of money that we manage for local Chinese. The alternative business, the factor business, we're the second largest factor provider in the world. These are all areas that are going to continue to grow. And you talked to the issue about active management. Those that generate alpha are going to do very fine. And it's going to be in asset classes like emerging markets and global.
In 2006, everybody was running around trying to make 14 basis points on every transaction. Are we back to that right now within the traditional Invesco bond shop?
Yeah.
Are we back to 06 where everybody's getting stupid about 14.14 percentage points, itsy bitsy amounts? Oh boy, I succeeded.
Yeah.
Are we back to this?
I hope not. And look, I think when you put on the business hat, first of all, we're legal fiduciaries, so you've got to be responsible for your clients in the first place. If you're not, game over at some point in time. So it's literally making sure that you're in line with your clients when you have those conversations.